An interesting case, where a gap up shares the same approximate range with a later gap down, with mostly below normal volume. This is due in part to indecision following the gap down, meeting strong support from the 2120 gap fill level. However, the medium to long-term picture is overwhelmingly bearish, as summarized with the clear trend line drawn from downswings prior to the past two larger gap downs. Now it is not so surprising to see a gradual move under the 2120 gap down area, with a slight bearish acceleration in the last 2 days. The bearish advantage is quickly lost as bearish price action and volume quickly dissipate after December 13th, which allows a natural bullish retracement to take place. Normally, there would be a downswing if not a stall back around 2120, especially near the end of the year with lower trading volume during the holiday season. However, the sudden and abnormal disappearance of selling pressure in early December had a major role here in seeing strong closes higher with relatively weak bullish volume. Some of this can be attributed to bearish exhaustion after the two gap downs prior to breaching 2120 towards mid-December. A very similar situation forms. Interestingly, the 2280 level near the closing price of the candle just before the gap up is where the current candle forms its real body to reject lower prices in the short term with the gap fill support. A real-world demonstration of why the theoretical frame of a gap starts at or near the closing price of the candle just before the gap forms. This price level, as seen before, generally marks the focal point of the gap fill range. The candle on May 14th can be called the gap fill candle. That defines a narrower point of interest in the wider gap fill range defined by the swing points before May 14th. Contention in the short term, but gap fill support keeps trading on a neutral to bullish stance. This is almost like the first gap up fill, except there was no breach of the gap fill support. However, there is still the element of a passive rise, with overselling followed by bullish momentum at consistent but not exceedingly high levels in terms of price action and volume. The abnormal dip below gap fill support did not occur here because bearish sentiment was not exhausted by two consecutive gap downs. In November, the downtrend line does provide resistance in what later turns out to be a minor resting phase in strong three methods rising price action. 2015 starts with another gap up, but this is a very ordinary gap up as bearish context is not overwhelmingly strong. The gap is filled without much incident, and there is even a compact double bottom at the end of March into April for the first reversal, which added to the bullish advantage around the 2690 level for the upswing later in July. The standard gap fill support was certainly stable, but nothing is ever a guarantee. That became apparent with successively lower downswing points ever since the first gap fill. This added to the strength of the bearish spike that breached the 2690 area in late August 2015 during a broader stock market drop. 2690 remains a key level since there was plenty of volatile activity near that level prior to the current bearish spike that returns attention back to 2280. Short-term developments are watched with great intent even by long-term investors, due to major selling at 2280 that is decreasing significantly. More tenuous trading while the market transitions into a clear, indecisive phase. This is a key reversal, and the same 2280 level can be reused to mark the current minor gap up fill area. It was a strong short-term reversal since there was no normal gap fill, but rather a strong surge to 2690, which now offers clear resistance. The volatile 2390 to 2280 range could be called a triple bottom, but it was difficult to identify during its development. It could also be called a flat bottom range around the 2280 level, depending on how swing points are counted with such large candles. In any case, the main point here is there was a clear support range that was definitively cleared to produce a rapid reversal. The exact bullish pattern is less important. It could have even been a double bottom or inverse head and shoulders. The characteristic of high volume breaking the lower range's upper boundary after holding support was the key factor to pay attention to. A compact double top formed to mark a clear area of resistance. A likely less strict triple top is underway. After a gradual bearish acceleration breached the 34 level, marking the lower boundary of the strict compact double top. A minor gap up complicates the situation for a short time, until strong bearish sentiment returns to place the 3250 area around the last clear upswing as a possible target. After falling much lower, the area around 3250 becomes a general area marking a rough range of resistance. After the small gap down in mid-August led to bearish exhaustion. This can be seen by recent range-bound trading, with mostly moderate volume. The gap down range quickly develops into a more bullish stance, with a clear incline developing after bearish spikes in mid-August that made little progress. An ascending triangle filled in the minor gap down from mid-August, and conveniently reused the 3250 area to mark the resistance range of the triangle. The uptrend line lost direct influence fairly quickly, but manages to outline the approximate trajectory of the aggressive uptrend that proceeded following a natural resting phase around the earlier gap down fill range in the 34s. When there is a major correction years later, it is not surprising firm support is found at the major mid to lower 30s ranges. Here there are examples of common phenomenon where major ranges, levels, and trend lines intersect with chart patterns and general ranges of major support and resistance. In this case, the focus is on gap ranges that intersected with some clear swing points and recent gaps from the past.